It's often said that the stock market in the long run is a weighing machine, that businesses that make the most money will be worth the most. But in the short run, the stock market is a voting machine, or I like to call it a beauty contest, that whichever looks more beautiful in the short term, share price goes up, and the ones that are not so beautiful in the short term, share price goes down, despite the fact that they make a lot of money. So four of my heavenly queens, out of four of my heavenly queens, three of them won the recent beauty contest, which is the earnings report, and one of them recently lost the beauty contest, but it's still a great and highly profitable company, right? So you know what I'm talking about. My four beauty queens are Amazon, beat earnings, price went up. Alphabet, beat earnings, price went up. Microsoft, beat earnings, price went up. But my last beauty queen, Facebook, Meta, had an acne breakout, so she kind of like lost the beauty contest. And people are saying her career's over and she's an ugly person. No, just because you get a pimple doesn't mean you're an ugly person, right? That's just short-term beauty contest. But as you guys know, Facebook Meta is still a great business and way ahead of the competition. And again, do watch my video on my analysis on Facebook Meta in my previous video. So in this video, I'll be talking about my other heavenly queen, which is Alphabet. Ticker symbol GOOG or GOOGL, that owns YouTube and Google. So they recently announced great earnings. They are one of the winners of the beauty contest and the price gapped up as a result. But more importantly, they did something really, really interesting. They announced a 20-for-1 stock split. So is that good news or bad news, and how does that affect you as an investor? And if you're not already an investor, is Google Alphabet still a buy at these levels? So let's find out in this video. So Alphabet just announced great results as expected. Their revenue for the last 12 months grew 41% for the year. Their net income to shareholders grew 88%. So that's amazing. In terms of their free cash flow, which is the most important thing when you evaluate a business, because that's how you value a business, right? So their free cash flow has grown from 42 billion to 67 billion. So that's a growth of, let's see, 49% growth in free cash flow. So it's a growing business, it's an extremely profitable business. And again, more importantly, they announced a 20-for-1 stock split, which means they're going to split their shares into 20 parts. So what does this mean? Let's take a look. So currently, as of last Friday's close, Alphabet, the stock is selling at, what's the latest price? It's selling at $2,865 per share. All right. Now, they're going to be splitting the stock on the 15th of July. So whatever the price is on that day, it will split by 20. So for example, let's imagine that on the 14th of July, the price remains where it is today, right? The price is at 2008. And let's imagine that you own one share of Alphabet. So what is the value of your Alphabet shares? It's $2,865, right? Now, after the share split, what's going to happen? The next day, you're going to wake up and you're going to find that every share that you own, every one share that you own will become 20 shares. Hey, sounds great, right? But don't be too happy, because the share price will split by 20 as well. So there'll be 2,865 divided by 20. There'll be $143 per share. So you wake up the next morning with 20 shares and each share priced at $143.25. So if you multiply that, the value of your shares are still the same, right? So understand that a share split doesn't make you any better off or any worse off as an investor. A share split doesn't change the value of the business itself. The intrinsic value of the business is exactly the same. Now, after the share split, the shares look cheaper psychologically, but is it actually cheaper? No, it isn't, because the intrinsic value of the current share gets divided by 20 as well. So you're getting a smaller piece of the business after a share split, but you get more pieces. So here's an analogy. Let's imagine that Alphabet, the entire business, is represented by a pizza pie. So this is the whole pizza. This is the value of the entire business of Alphabet. And currently, let's imagine that Alphabet has only 4 shares. Now, of course, there are millions of shares, but let's keep it simple and imagine there are only 4 shares. And each share represents a slice of the pizza, a slice of the business. So currently, let's imagine that you own one slice of this pizza, right? You own one slice of the pizza, okay? So what happens in a share split is they take one share and they divide that one share into 20 smaller shares. So they take this slice of pizza and they divide it into 1, 2, 3, 1, 2, 3, 4, roughly, right? So they divide into 20 smaller slices of pizza. So again, like I said, after a share split, what happens? Instead of one share, you now own 20 shares. But the new share is smaller than the old share, so the actual value of all the shares remains exactly the same. So in a share split, are you getting more pizza? No, you're getting the same amount of pizza. You're just getting the same pizza in smaller pieces. So why does a company do a share split when it doesn't change the value of the business at all? Because after a share split, the shares look cheaper psychologically, and the shares become more affordable for retail investors to buy. You see, currently one share of Alphabet is selling at about close to $3,000, and a lot of big money institutional investors and people like myself, we can buy them very easily, right? But there are a lot of retail investors who have small accounts and they can't afford to buy one share. They say, if I buy one share of Alphabet, I can't buy anything else, right? Because they got really small accounts. So by splitting the share, it makes the shares more affordable so that the greater masses of investors will buy more shares. So theoretically, this will lead to a greater demand for the shares in the short term. So more demand versus supply, this should increase the price of the shares, at least in the short term. Now, so that's the first reason to get more people buying Alphabet shares. Now, second reason is because, you see, Alphabet's a great business and it should be included into the Dow Jones Index, but it has not been included. Why? Because the share price is too big. So when the share price is too big, in the case of Alphabet and Amazon, they can't be put into the Dow Jones Index because the Dow Jones is a price-weighted index. If one company's share price is too high relative to the rest, it would skew the index too much. So in other words, if Alphabet increases by 1%, the whole Dow Jones will increase tremendously because of one company, right? So by splitting the shares and Alphabet becomes a $100 share or $200 share, then it can be easily included into the Dow Jones Index. So once a company is included into the Dow Jones, what does it mean? It means that ETFs and funds that own the Dow Jones have to now buy Alphabet. And that again leads to more demand for the shares by funds, by ETFs, by retail investors, and theoretically that should increase the share price of Alphabet. So that's why the company is doing it. Now, so for us as investors, is there any incentive? Is there anything good for it? Again, yes, if you are having a small account, it'll now make it easier for you to buy Alphabet shares. At the same time, if you are trading options, it's now easier to buy 100 shares of Alphabet. And so with 100 shares, you can sell covered call options, you can sell cash secured put options a lot easier. So it makes it easier to trade options on Alphabet as well. So is Alphabet still a buy at these current levels? And should an investor buy before the share split or after the share split? Now, again, the most important thing is to ensure that before you buy shares of a company, number one, it has to be undervalued. You want to buy only when the share price is selling below the intrinsic value of the share, whether is it before or after the split. So let's do an intrinsic value calculation, number one. Number two, you want to ensure that you buy when price has retraced to a level of support. Now, the good thing is after Alphabet announced their earnings, they the price gapped up initially, right? So it gapped up over there. It was poised to fly. And then because Meta, Facebook announced bad earnings, that kind of like soured the mood of the market for a couple of days. So Alphabet got pulled back, which is great news because this gives us a great entry point for investors who have not added Alphabet. It's kind of like Alphabet won the beauty contest and Facebook lost the beauty contest and got into a meltdown, got upset and pushed Alphabet off the stage temporarily, right? So now Alphabet is kind of like getting back on the stage and say, but I won, right? Okay? So let's take a look at this. So you can see this is what we call a gap up, all right? Gap up and pull back to a level of support. So you can see that this has been a pretty strong level of support for Alphabet, and it also coincides with the 50 moving average. Now, so what I did was when I saw that, I did add more shares of Alphabet myself. Okay, so disclaimer, I've been owning Alphabet for quite some time. I'm already an existing shareholder, but I did add some more shares on Friday. So if you take a look at my portfolio, for example, there you go. These are my 4 heavenly queens. Alphabet's over there. You can see my average price is about 1,002. And I added more shares on Friday at about 2,008. So that actually increased my average price a bit. Would I add a bit more shares? Yeah, I may add more shares depending on the price action. So what's the current intrinsic value of Alphabet? And if you buy right now, are you still getting a discount from the true value of the business? Now, I did a quick calculation using a 20-year discounted free cash flow model. And this is what it looks like, right? So in the last 12 months, Alphabet generated 67 billion in free cash flow. So we're going to project that for the next 20 years, all right? It's got 12 billion in debt. It's got 139 billion in cash. Wow, right? So what kind of growth rate can we use for Alphabet? Now, bear in mind that they have been growing at 40% a year. And last year, their free cash flow grew at 49%. So what are we going to use moving forward? Now, I'm only going to use a very conservative 19% growth in free cash flow. Only 19%, that's it. Half of the current growth. So for the first 5 years, I'm assuming 19% growth, and thereafter halving it to 9% in the next 5 years, and then for the last 10 years, only growing at 4%. So very conservative growth moving forward, right? Now, currently, it has got 661 million shares. It's kind of like the pizza is divided into 661 million slices of pizza. Now, bear in mind that Alphabet has got 3 types of shares. You've got what is known as the Class A shares, the Class B shares, and the Class C shares. So Class A shares, the ticker symbol is GOOGL. The Class C shares, ticker symbol GOOG. Now, people like to ask me, which one should I buy? It doesn't matter. You can buy either one. The only difference is that Class A shares gives you voting rights. Class C shares, no voting rights. Unless you want to go and vote at the shareholder meeting, it really doesn't matter, okay? Now, the Class B shares, you can't buy them because they are held by the insiders only, right? So you can't buy this one. Now, so what you're seeing here is the number of shares includes Class A, Class B, and Class C altogether, all right? Now, during the share split on the 15th of July, all the classes of shares will all be divided by 20. So they will split them all, right? So before the share split, there are 661 million slices of pizza. Okay, now, so putting in all these numbers, this gives us an intrinsic value of, ta-da, $3,757. So that is what one share is really worth, okay? And as of the last closing price, it's now selling at $2,800. Is that a good deal? Yes, sir, bought, because by buying at 2008, I'm buying it at a 23% discount of the intrinsic value. So it's still a pretty good deal. Now, what happens after the share split on the 15th of July? After the share split, the number of shares here, right, will increase by 20 times. So 661 times 20 will be 13280. Boom! All right, so after the share split, the intrinsic value of the new share will become $187. All right, so for now, the shares are worth 3,007, and that's why even though I already have quite a number of shares of Alpha, but bought at 1,008, was it 1,008 my average price? Sorry, 1,002, that's my average price, right? So even though, again, I bought them at a lot lower price, I'm willing to pay a higher price today because the company is worth a lot more today than it was 1, 2, 3, 4 years ago. So remember that a great business, every year, the intrinsic value of the shares, the value of the business keeps growing as it generates more and more free cash flow. So it's okay to pay a higher price as long as you're buying it at less than what it is really worth, all right? Now, let's go back to the stock charts again. So where do we expect Alphabet to go from here? Now, again, we can't predict for certain the short-term price movement. We know that a great business will go up over time, but in the short term, it's hard to predict where it's going to go. But we can kind of like guess based on patterns, right? So let's take a look at Apple. How did Apple's share price behave after they announced the stock split? And what happened thereafter? All right, so let's learn something from the Apple stock split. So Apple split its stock in 2020, all right, which was about 2 years ago. So let's take a look at what happened. There we are. That's the stock split. Okay, so Apple's stock split was announced here at the end of July. Let's see. Yeah. So on the 31st of July, Apple announced their stock split, right? It was announced here. And upon the announcement, the price went up. And on the day of the actual stock split, which was here, what happened on the day of the actual split? After the split, the price went down. So that seems to be the pattern. When a company announces a split, price goes up. When it actually splits, price goes down, but then of course it then goes up again, all right? Because Apple's a great business as well. So based on this pattern, what could we expect from Alphabet, all right? So we could expect that, now again, the shares will split on 15th of July, so that's still March, April, May, June, so that's about 5 months, right? It's a bit different because Apple, from the announcement to the split, was only 1 month. But this is kind of like 5 months. So it could be a bit different, right? But I'm not surprised that we should see Alphabet rallying, okay, to the 15th of July. And then after the split, retraces back down again. And then it goes up again, okay? So let's see what happens. I hope you enjoyed this video and you're now more aware about what a stock split is and how you can take advantage of the stock split. So may the markets be with you, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.